You might think insurance and, picture endless paperwork, maybe a necessary evil, or just a sea of dry statistics. Kind of boring, maybe.
Yeah, it doesn't always sound like the most exciting topic on the surface, right?
But what if we told you it's actually this vibrant, high-stakes arena full of wildly different business models, cutting-edge tech, and really fierce competitive strategies?
It genuinely is. It's a world that's shaping how we live, how we work, how we protect basically everything we own every single day.
And there's honestly far more to it than meets the eye. So today we're taking your sources, this fascinating comparative analysis of 9 distinct insurance powerhouses, and we're embarking on a deep dive. Our mission: cut through the jargon, really illuminate the contrasting approaches these companies take to risk, distribution, and how they create value, and reveal the sometimes surprising financial performance that results.
Yeah, and you should walk away with a much clearer framework for understanding this essential, but often pretty opaque industry.
Exactly. We'll explore 5 distinct strategic archetypes, from global giants to these really nimble specialists. Then we'll unpack how their choices in reaching customers actually impact their bottom line. And finally, we'll look at the unique risks and strategic pathways defining their futures. Okay, let's unpack this.
Let's hear it.
So to kick us off, let's talk about the foundational strategic choices these companies are making. Your sources categorize these 9 insurers into 5 distinct archetypes, which honestly really helps make sense of their fundamental approach. It's almost like looking at different species evolving unique survival strategies in the same ecosystem,
That's a great analogy, actually. And what's truly fascinating here is that even though they're all technically in the insurance sector, their core identities, the ways they create value, they just diverge dramatically. It's a really vivid illustration of how strategic positioning dictates almost everything else, from their operational scale and market focus right down to their distribution channels and even their ultimate financial performance. It's not just about what they insure, but how they choose to insure it, who they choose to serve, and the unique capabilities they build to actually execute that vision.
That makes perfect sense. So let's dive into the first one. The global diversified leaders. These are the names, many of us probably recognize. Companies like the Travelers Company's ticker TRV and the Chubb Corporation, CB. What's the core strategic principle here? What are these giants fundamentally betting on?
Right. The fundamental bet for these companies is really on sheer scale and breadth. Their core identity is defined by just immense global operations and these really comprehensive product suites across both commercial and personal property and casualty or P&C lines.
Okay.
Think of them as the established titans of the industry. They're capable of covering this vast array of risks worldwide for a really diverse customer base. I mean, take Chubb, for instance. They operate in 54 countries and territories. They offer everything from complex commercial P&C for huge multinational corporations down to personal P&C for high net worth individuals, plus accident and health, reinsurance, even life insurance. It's vast.
Oh, okay.
And Travelers, while, a leading U.S. P&C insurer primarily, also has significant international operations. They provide crucial coverage for auto, home, and businesses across many, many geographies. Their reach is just, it's unparalleled. They're generalists, but generalists on a truly grand and resilient scale.
It sounds like their strength really comes from being everywhere and doing a bit of everything. But what makes these massive players so resilient, so dominant in what's still a really competitive landscape? What are their competitive moats, those advantages that protect their business?
Yeah, you've hit on a crucial point there. Their moats are indeed quite substantial. First, there's just immense brand recognition and trust. They've spent decades, sometimes over a century, building their names into symbols of reliability. And that's critical when customers are entrusting you with, their most valuable assets.
Sure.
Second, they have these deep, really tenured relationships with extensive networks of independent agents and brokers. These agents act as vital conduits to customers. And these aren't just transactional relationships. They're often decades-long partnerships that drive consistent, high-quality business their way.
That relationship piece sounds key.
It is. And crucially, their financial resilience comes from that broad diversification across geographies, product lines, customer segments. It provides this powerful shock absorber effect against, say, localized economic downturns or large single events like natural catastrophes.
Right.
Their sheer scale lets them absorb massive losses. Think a catastrophic hurricane that would simply overwhelm and, frankly, sink smaller, less diversified players. This capability also uniquely positions them to serve those big multinational corporations that need seamless, coordinated coverage across multiple borders.
So these are the heavyweights. They leverage immense scale and breadth, not just to cover vast markets, but also to fundamentally manage and absorb risk in a way smaller companies just can't. It's a strategy built for stability, massive reach, deep pockets.
Precisely. They are built for long-term endurance, consistently compounding returns by managing a diverse book of business and leveraging those really strong balance sheets.
Okay, moving on then. We have a group called the Specialty Underwriting Champions. This includes companies like W.R. Berkley, WRB, RLI Corp. RLI, Arch Capital Group, ACGL, and Kinsale Capital Group, KNSL. The sources call these the sharpshooters of the industry. What exactly earns them that champion title in such a specialized field?
Yeah, sharpshooters is a very apt description for this group. Their champion status really comes from thriving by focusing on niche, complex, and often pretty hard-to-place risks.
Okay.
They primarily operate in what's known as the excess and surplus market, or E&S. This market deals with risks that just don't fit into the standardized, highly regulated insurance policies you see elsewhere.
Right. The unusual stuff.
Exactly. And because these risks are more unusual, they require highly specialized expertise. So the E&S market often commands higher, more profitable premiums. Their success isn't about breadth across all risks like the global leaders. It's about this unparalleled depth of expertise in specific, often overlooked areas.
So it's not about being a general store. It's about being the absolute best at a very specific craft.
Right.
What are the key factors that enable them to succeed in these specialized areas where, others might hesitate or even fail?
Well, their success really boils down to three core factors. First, superior specialized underwriting. They possess deep, often proprietary expertise in unique and unconventional risks. This lets them accurately assess and price these complex exposures where generalists might just shy away because of the uncertainty involved.
Makes sense.
Second, they practice incredibly disciplined risk selection. They don't just take on any complex risk that comes their way. They carefully choose what to take on, meticulously evaluating each submission to avoid potential pitfalls and maintain profitability. This is where their deep knowledge really shines.
And they say no a lot, presumably.
Yeah, they have to. And third, they exhibit remarkable operational agility. The E&S market is dynamic. New risks constantly emerging, market conditions shifting rapidly. These companies have the ability to respond quickly to those market changes and unique client needs. They can often design bespoke coverage solutions faster and more effectively than larger, more bureaucratic players. They can literally pivot their focus to new emerging risks or market opportunities with incredible speed.
Okay, here's where it gets really interesting for me. These companies aren't trying to be all things to all people. Not at all. They're finding those specific, complex problems and becoming the absolute best at solving them and extracting significant value in the process. But I see there are even distinct differentiators within this group, suggesting varied approaches even within specialization.
Absolutely. Even within the specialized group, there are distinct strategic nuances. For example, Kinsale Capital really stands out for its technology-driven, low-cost operating model.
Technology.
Yeah, they've built this incredibly efficient platform that allows them to underwrite complex E&S risks with lower expense ratios than many peers. That consistently delivers industry-leading underwriting margins. This technological edge is a key differentiator for them.
Okay.
Then you have Arch Capital. They diversify their specialty focus with significant operations in reinsurance and mortgage insurance. So they're providing broader risk management solutions to sectors like the global housing market, in addition to their robust E&S business, a bit more diversified within their specialization.
Interesting.
W.R. Berkley operates through this highly decentralized structure. Nearly 60 distinct business units, each a specialist in a very specific niche market. This grants them a remarkable combination of focused expertise and diversified exposure across many unique segments. Very unique structure.
Almost like a federation of specialists.
Kinda, yeah. And RLI Corp concentrates on underserved, niche property, casualty, and surety markets. Again, picking their battles where their expertise truly shines and where they can maintain pricing power. So each of these companies has found its own unique secret sauce for excelling in the toughest risk segments.
It's like they each have their own unique blend of expertise and operational efficiency for tackling the most challenging risks. It proves that sometimes deep focus is actually more powerful than broad reach.
Exactly. It's a strategic choice. Excel in specific, often less competitive segments and potentially yield superior results because of it.
Okay, next archetype, The scale-driven personal lines innovator. And this is a category defined by just one company, Progressive Corp, PGR. This sounds like a story of disruption. How did Progressive manage to, well, redefine personal auto insurance? What's their unique approach using tech and data?
Progressive is indeed a singular archetype and, yeah, a true disruptor. They've built this dominant position in the U.S. personal auto market through a genuinely groundbreaking direct-to-consumer model, DTC.
Right, DTC.
Historically, auto insurance was primarily sold through agents. Progressive fundamentally changed how car insurance is sold, priced, and how customer relationships are managed. Now, while they do maintain an agency channel, which is smart, their competitive identity is undeniably defined by their direct business. Customers can get quotes, buy policies, manage them all online or over the phone, cutting out the traditional middleman for many.
How did they achieve such dominance, rewrite the rules like that? What were their core competitive advantages that let them innovate so effectively?
Well, Progressive's success is built on a few really formidable pillars. First, massive, sustained brand investment. They've poured billions, literally billions annually, into pervasive advertising. They're one of the most recognizable and top-of-mind brands in the entire industry. You can't avoid their ads.
True.
Second, and maybe most critically, they leverage incredibly sophisticated data analytics. They use vast amounts of data, far more than many peers historically, to understand risk with incredible precision. This deep data intelligence feeds directly into their underwriting and pricing models, giving them a significant advantage in accurately assessing and segmenting risk.
The data piece seems huge.
It is. And perhaps most famously, they were pioneers in telematics, using technology either installed in vehicles or now through phone apps to price risk based on actual driving behavior. How you drive, when you drive, how much you drive.
Exact shot, though.
Exactly. Snapshot was the big one. This was revolutionary. It allowed for incredibly granular and personalized pricing that rewards safer drivers. It fundamentally changed the risk-reward equation for consumers and for the company.
So Progressive isn't just an insurer. They basically built this high-tech data and marketing powerhouse that happens to sell insurance. It's a fascinating redefinition of what an insurance company can be. All about speed, data, reaching the customer directly.
That's a perfect summary of their model. Their strategy is highly capital-intensive from a marketing perspective, given the billions they spend on ads, but it allows for rapid scaling and efficient customer acquisition. Their growth becomes a direct function of their marketing efficiency and their technological prowess in data analysis and pricing. It really sets them apart from virtually every other traditional insurer.
Okay, our fourth archetype is the super-regional Main Street player, exemplified by Selective Insurance Group, SIGI. This sounds like a much more localized, maybe relationship-driven approach. What's the core essence of their strategy? How do they succeed with this kind of localized focus?
Selective truly embodies a relationship-intensive model. They partner really closely with independent agents to serve commercial and personal clients, but their key differentiator is that focused geographic footprint. They operate within specific U.S. regions, primarily 35 states in the eastern and midwestern U.S.
So not nationwide.
No, not trying to be national or global.
Yeah.
Instead, they're aiming for deep regional penetration and strong community ties. Their core strategy blends a high-touch, field-based underwriting and claims model with modern technology.
High touch.
Meaning highly personalized service, building robust local relationships. They prioritize that face-to-face interaction and deep understanding of local market nuances. They're deeply embedded in the communities they serve, often with underwriters and claims adjusters living and working in those very regions.
So if the global leaders are the big department stores and the specialists are the high-end boutiques, Selective is like the trusted local general store, deeply embedded, valuing personal service and local knowledge.
That's an excellent analogy. Their franchise value distribution model is built explicitly on these strong relationships with a select group of high-quality agency partners. This creates a very sticky business. Loyalty and local knowledge form a powerful competitive advantage that's difficult for larger, more impersonal players to replicate. Customers often value that localized expertise and long-standing personal relationship, especially for their commercial needs.
And finally, we have the middle market distribution disruptor, Primerica, PRI. This one feels like a complete outlier in this group.
Yeah.
Moving away from P&C insurance entirely, how does Primerica's model fundamentally differ from all the others we've discussed? What are the implications?
Primerica truly is an outlier here. They focus not on property and casualty insurance like all the others, but on providing term life insurance and investment products, specifically targeting middle-income households across North America, so a completely different segment of financial services. What truly defines their approach and makes them a disruptor in their own right is their massive independent sales force. It operates under a multi-level compensation structure. This model provides unparalleled grassroots reach into that often underserved demographic, the middle-income market that traditional financial advisors might overlook or find less profitable to serve.
So Primerica isn't really selling a policy so much as it's activating this huge human network to reach its customers. That's a totally different ballgame from DTC or agency models.
It absolutely is. This model effectively externalizes the costs of recruitment, training, and sales to the representatives themselves. That creates significant operating leverage for the parent company.
How does the compensation work exactly?
Representatives are compensated not only for their own sales, but also for sales made by other representatives they recruit and train into their downline. So it scales through building out this vast human capital network. Their growth is fundamentally dependent on their ability to recruit, motivate, and retain this expansive sales force. And if we connect this back to the bigger picture, this divergence in business models really highlights the fundamental trade-offs, right? You see the high specialized underwriting margins for E&S players, you see the stability and scale of global leaders, and then you see the unique capital-like growth of Primerica driven entirely by its human network. Each strategic choice is just a critical factor explaining the differences in their operational structures and ultimately their financial performance.
These unique business models, yeah, they don't just affect what they insure, but how they get their products into your hands. Let's delve into their distribution strategies now, because that seems like it's often where the rubber truly meets the road. In terms of efficiency, customer engagement.
You've hit on a critical distinction there. The method an insurer chooses to reach its customers often defines its moat, that sustainable competitive advantage we talked about.
All right.
It's not just a sales channel, it's really a strategic asset. It has long-term implications for growth, profitability, overall market positioning. These choices are fundamental to who they are.
Let's start with what many might consider the traditional path. Independent agents and brokers. This seems to be the preferred channel for a lot of the companies we discussed, right? Why is this model still so prevalent? What makes it successful?
It is indeed a bedrock of the industry. Companies like Travelers, Chubb, W.R. Berkley, RLI, Arch Capital, Kinsale, and especially Selective, they all heavily rely on this model. They leverage this vast network of third-party professionals, these independent agents and brokers, to distribute their products.
And these agents are advisors.
Exactly. They act as trusted advisors to clients, especially for complex commercial or specialty risks. They match clients with the right policies, provide that crucial human touch, local expertise, and ongoing service. They essentially serve as an extension of the insurer's sales and service team, but critically, they maintain independent client relationships.
And what are the keys to success for an insurer using this model? It sounds like it's more than just signing up agencies.
Oh, absolutely. Success here is deeply predicated on cultivating deep, long-term relationships with these agencies. It requires providing superior service and claims handling not just to the end clients, but crucially, to the agents themselves. You have to make them want to place business with your company.
Right. Keep the agents happy.
Exactly. Offering competitive compensation, robust technological support that also attracts and retains the best agency talent. Selective, as we mentioned, has explicitly built its entire business around this. That high-touch approach where empowered, field-based employees work directly and consistently with a select group of high-quality agency partners. They call their distribution model a franchise value.
Franchise value, okay.
The moat here is the stickiness of these relationships. They're slower to build, require consistent effort, investment, but they provide this resilient, often higher quality flow of business that's less susceptible to pure price competition. Customers, especially businesses, often value that expertise and personal relationship. Loyalty becomes a key benefit.
It truly sounds like a focus on human connection, and expertise is paramount here. Something that builds deep trust, loyalty over time. Makes it much harder for competitors to just chip away at their business based on price alone.
Precisely. It's an investment in human capital and relationships that pays dividends in stable, quality business over the long run.
Okay, so in stark contrast to that relationship-driven model, we have the digital disruptor, embodied by Progressive with its direct-to-consumer or DTC model. How did Progressive establish this as such a dominant force? What are its key advantages? What are the implications for the insurance landscape?
Progressive truly pioneered the DTC model in the U.S. personal auto market, challenged that traditional agent-centric approach head-on. Now, while they cleverly maintain a robust agency channel too, their competitive identity is undeniably defined by their direct business. Customers can seamlessly get quotes, buy policies online or over the phone.
Cutting out the middleman.
For a significant portion of their business, yeah. And that has profound implications.
And what are the driving forces behind this digital disruption? How do they make such a capital-intensive model work so effectively?
Yeah.
Because that marketing spend must be huge.
It is huge. It's largely fueled by that massive and incredibly sophisticated marketing engine we talked about.
Yeah.
Billions annually on pervasive advertising, building one of the most recognizable brands.
Yep.
This direct model gives them a direct relationship with their customers, which, importantly, eliminates agent commissions for that direct business. That's a significant cost saving they can reinvest in marketing or pass on through competitive pricing.
Okay.
And crucially, it generates this vast trove of proprietary data from millions of direct interactions. This data continuously informs and refines their underwriting and pricing models. It gives them this powerful iterative advantage over time. Their technology lets them quickly process, analyze, act on this data, offer personalized quotes, adapt to market conditions with remarkable speed.
So Progressive basically built a tech company with an insurance wrapper around it. All about speed, data, direct customer connection. Fundamentally different strategic levers than the agent-based model.
That's a very apt description. This strategy is capital intensive from a marketing perspective, but it allows for rapid scaling and customer acquisition. Their growth becomes a direct function of that marketing efficiency and technological prowess. It lets them reach a massive market segment that's looking for convenience and competitive pricing.
And then we have Primerica, with its truly unique approach, the human network, built on a multi-level independent sales force. This isn't just different. It seems like it's operating on an entirely distinct strategic plane. Can you break down how this model works? What are its specific strategic impacts?
This is a distribution model that truly stands apart from anything else in this group. Primerica distributes its term life insurance and investment products through this enormous network over 152,000 licensed independent representatives. It's not just a sales team, it's a vast, interconnected human network that leverages personal relationships and referrals.
And their compensation structure sounds quite unique, almost like network marketing. How does that impact their business?
It is similar in structure. Representatives are compensated not only for their own direct sales, but also for sales made by other representatives they recruit into their downline. This multi-level structure creates significant operating leverage for Primerica. Why? Because it effectively externalizes many of the costs, recruitment, training, sales management to the representatives themselves.
Okay. The company doesn't bear those costs directly.
Right. The company doesn't need to employ a massive salaried sales force. Instead, it provides the products, training, licensing support, while the representatives build their own businesses and networks. This provides unparalleled, grassroots-level access to that middle-income market, a demographic often underserved by traditional financial advisors and banks who might focus on wealthier clients.
A powerful, people-intensive model.
Exactly. It scales through network effects. Primerica's growth is fundamentally dependent on its ability to attract, motivate, and retain this vast sales army. And these distinct distribution choices, they create structural differences in operating expenses, strategic imperatives. Progressive success is tied to brand equity, cost per acquisition. Primerica's fortunes are linked to its human capital network. And the agent-based carriers depend on being the preferred partner for the best agents. Each choice is a core strategic gamble with distinct advantages and challenges.
It's clear these companies take profoundly different paths to market, each building a unique competitive advantage around how they connect with customers. But how do those paths ultimately translate into actual results? Let's dive into their financial scorecards, where the rubber really hits the road.
Yeah, absolutely. This is where we truly see those strategic choices reflected in performance. The data highlights a pretty clear bifurcation in outcomes, especially between the agile specialists and the scaled incumbents, and then the distinct model of Primerica. It really underlines that different strategies lead to fundamentally different financial profiles and ultimately different ways to create shareholder value.
Let's start with top-line growth dynamics. In this competitive environment, who's growing fastest and what's driving that acceleration?
Okay, looking over the past 5 years, say 2019 to 2024, Growth trajectories have varied considerably. It really reflects each company's market position and the cyclicality of their chosen segments. The standout performers, in terms of just explosive growth, have undeniably been the E&S specialists.
Right, the sharpshooters.
Exactly. Kinsale, for example, delivered truly explosive growth. They capitalized masterfully on what we call a hard market, that's a period with rising rates, reduced capacity from standard carriers. Its annual revenue increased by an astonishing 29.7% in 2024, 46.0% in 2023, and 28.4% in 2022.
Wow, those are huge numbers.
Huge numbers. This exceptional expansion comes from a mix of highly favorable pricing in their niche markets and just a strong flow of submissions, difficult to place risks that standard carriers were increasingly unwilling to take on. Arch Capital also posted robust growth. Net premiums written in their insurance segment increased 17% in 2024, helped by organic opportunities and a strategic acquisition. They, too, capitalized on those favorable market conditions for specialty risks.
That's incredible growth for the specialists, clearly benefiting from specific market tailwinds. What about the personal lines innovator, Progressive? How does their growth compare?
Progressive has been just a relentless market share gaining machine in that highly competitive U.S. personal auto market. Its annual revenue grew by 21.4% in 2024 and 25.2% in 2023. That's driven by its powerful brand, continuous marketing investment, and those sophisticated pricing advantages from data and telematics. Their growth is really a testament to their operational efficiency and direct customer access.
Still very strong growth.
Very strong. Then you have the global leaders. Travelers, for example, grew net written premiums by a solid 8% in 2024 to a record $43.4 billion. That marked its 15th consecutive year of top-line expansion, demonstrating consistent, diversified growth. Chubb's global P&C premiums grew by nearly 10% in 2024, reflecting its broad global footprint and diverse product offerings.
So the key insight here.
The key insight is that while the specialist growth is partly cyclical, benefiting heavily from specific favorable market conditions, Progressive's growth seems more structural, driven by its unique brand and data advantages. The global leader's growth, meanwhile, is tied more to broader economic activity and general P&C pricing cycles, showcasing resilience and consistent expansion, just on a massive base.
Okay. Next, let's look at underwriting profitability. This seems to be the purest measure of how well an insurer actually prices and manages risk. The report emphasizes a combined ratio divide. Can you explain what the combined ratio tells us and why there's such a divide here?
Right, the combined ratio. It is, simply put, the purest indicator of underwriting discipline and efficiency. You calculate it by adding an insurer's loss and loss adjustment expenses to its underwriting expenses, then dividing that sum by its earned premiums.
Okay.
A ratio below 100% means the company is making an underwriting profit before considering any investment income. They're profitable purely from the business of insuring.
Got it. Below 100 is good.
Below 100 is good. And on this critical metric, the E&S specialists have a clear and consistent advantage. It's a key insight into their success. Kinsale is consistently industry-leading with exceptionally low combined ratios, 76.4% in 2024, 75.4% in 2023, just remarkable profitability.
How do they achieve that?
It's due to that proprietary technology we mentioned, which fuels a highly efficient, low-cost operating model. Their expense ratio is just 20.8% in 2024. Combine that with their pricing power and hard-to-place risks, reflected in a very strong loss ratio of 55.8% in 2024. RLI Corp also boasts an impressive record, achieving its 29th consecutive year of underwriting profitability in 2024 with a combined ratio of 86.2%. This consistent outperformance highlights their superior underwriting expertise and disciplined risk selection in their niche markets.
That's a stark difference from some of the others. Really emphasizes the benefits of specialization. What about the diversified and standard lines carriers? How do their combined ratios compare?
They generally exhibit higher and often more volatile combined ratios. Selective Insurance Group's 2024 combined ratio was 103.0%. That's above the profitable threshold. It reflected 6.5 points of catastrophe losses and, importantly, 7.1 points of unfavorable prior year casualty reserve development, indicating pressure from that social inflation trend we'll touch on later.
Okay, so over 100, meaning an underwriting loss there.
For that period, yes. Travelers, for Q2 2025, reported a combined ratio of 90.3%. That was a significant improvement, largely due to lower catastrophe losses in that specific quarter. Chubb posted a strong 85.6% combined ratio in the same quarter, demonstrating disciplined underwriting across its broad global platform. Progressive's combined ratio is highly sensitive to intense competition in the auto market and claims trends, but its 5-year average consistently outperforms the broader private passenger auto composite, showcasing its sophisticated underwriting acumen even in a tough market.
So the divide.
The significant gap in underwriting profitability shown by the combined ratio between the E&S specialists and the standard lines carriers. It primarily reflects the pricing freedom and less intense competition of the unregulated E&S market versus the challenges of rate regulation, intense competition, and higher catastrophe volatility that are prevalent in standard lines.
So it's not just about how much business you write, but fundamentally about how profitably you write it, especially looking purely at the underwriting side.
Exactly. The ability to manage losses and expenses relative to earned premiums is just foundational to long-term success. It truly separates the top performers.
And how do these individual performances translate into overall profitability and returns on capital? Usually measured by return on equity or ROE. This is often seen as the ultimate measure of generating value for shareholders.
Right, ROE. It measures a company's efficiency in generating profits for shareholders. It combines both underwriting and investment performance relative to the equity invested in the business. And again, the specialty players truly shine here.
Kinsale again.
Kinsale led the group with an exceptional ROE of 32.3% in 2024. W.R. Berkley posted a very strong 23.6% ROE in 2024. These outstanding results are primarily driven by their high underwriting income. It demonstrates that their specialized focus translates directly into superior shareholder returns.
In Primerica, their model is so different.
Primerica also generates a very high ROE. They reported an impressive 33% in Q2 2025. Now, this comes from their unique capital-light distribution model and the stable, predictable earnings generated from their large in-force term life insurance book. It allows them to generate high returns on a comparatively smaller equity base. Different mechanism, but still high ROE.
And the larger, more diversified companies, how do their ROEs stack up?
The global leaders produced solid, though generally more moderate, returns. Travelers reported a core ROE of 17.2%, and Chubb reported a core operating ROE of 13.9% for 2024. Their returns, while generally lower than the top-performing specialists, are generated on a much, much larger capital base. They demonstrate powerful, diversified earnings generation from their expansive franchises.
Any others?
At the lower end for 2024, Selective's non-GAAP operating ROE was 7.1%. That was weighed down by those underwriting challenges and reserve developments we discussed earlier.
So what does this all mean for investors? For understanding value creation? The market clearly rewards companies that can sustainably generate these high ROEs, but often at different scales and through different mechanisms.
Indeed. The disparity in ROE across this group is a primary driver of the wide divergence in their market valuations. It's a key indicator of shareholder value creation. It tells us that even within the same industry, different strategic choices lead to very different efficiency and profitability profiles. An exceptional ROE typically signals a strong competitive advantage and efficient capital utilization.
Let's not forget investment income, though. How does the concept of float and an insurer's portfolio strategy factor into all this, especially given that P&C insurers hold premiums for a while before paying claims?
Right, investment income. Generated from policyholder premiums, often elegantly called float, is a critical component of an insurer's total earnings, especially in the P&C sector where claim payouts can take time.
Explain float again.
Think of float as basically an interest-free loan that policyholders effectively provide to the insurer. It's money the insurer holds before it needs to pay out claims. And the clever part is, they get to invest that money, creating this powerful, often overlooked profit center that can stabilize earnings even when underwriting faces headwinds.
A nice cushion.
A very nice cushion. The general investment strategy across this group reflects a conservative, capital preservation-focused approach. Portfolios are heavily weighted toward high-quality fixed-income securities, bonds, mostly.
Example.
Travelers, for instance, holds a staggering 94% of its $94.2 billion investment portfolio in fixed income, and 98.8% of those holdings are rated investment grade. This generated a substantial $3.0 billion in after-tax net investment income in 2024 alone. Similarly, RLI targets a prudent allocation, 80% bonds, 20% equities, with its fixed income portfolio maintaining an average quality rating of AA. Very high quality.
So a stable conservative investment portfolio is a core pillar. Are there any variations in this conservative approach, or is it pretty universal?
There are some strategic variations. W.R. Berkley, for example, complements its high-quality, short-duration bond portfolio with more opportunistic investments, things like common stocks, merger arbitrage, private equity, or commercial real estate. These alternative investments, managed with discipline, have actually been accretive to its overall ROE over time, added another layer to their total returns.
Interesting. A bit more aggressive there.
Relatively speaking, yes. Arch Capital also emphasizes a total return approach. Its 2020 portfolio generated a robust 7.77% total return. Critically, the rising interest rate environment of recent years has been a significant tailwind for the entire sector.
How so?
As older, lower-yielding bonds mature, the proceeds get reinvested at today's higher rates. This leads to steady, predictable growth in net investment income. Travelers, for example, explicitly expects its fixed income portfolio alone to generate approximately $3 billion in after-tax income in 2025, demonstrating the immense compounding power of rising rates on their float.
So this reliable stream of investment income acts as a crucial buffer, especially when underwriting results are maybe a bit more volatile due to cats or competition. It's a quiet but incredibly powerful force on the balance sheet. Ensures consistent earnings even when the underwriting cycle is challenging.
Exactly. It's a fundamental strength for the industry, a consistent source of earnings that helps smooth out the inherent volatility of the underwriting business and contributes significantly to overall profitability.
Okay, while strong financial performance is vital, a company's ability to manage its capital and maintain a resilient balance sheet is truly the bedrock of long-term success, especially for an insurance company that has to be there to pay claims, sometimes decades down the line. So let's talk about that financial foundation.
Yeah, absolutely critical.
Performance is one thing, but how strong is the foundation these companies are built on? Your analysis delves into their capital management, their balance sheet resilience aspects that are absolutely crucial for long-term viability and shareholder value. I mean, the essence of insurance is promising to pay future claims, right? So capital strength is paramount.
You're right, and this raises an important question. How do these companies not just generate capital, but also effectively protect it and return it to shareholders? It's fundamentally about being prepared for the unexpected, which is, after all, the entire premise of insurance. A strong capital position lets a company underwrite new business confidently, withstand unexpected large losses, maintain financial flexibility, all while consistently returning value to shareholders.
Let's start with their capital allocation philosophies. How do these diverse companies decide what to do with their profits, their excess capital? Do they all follow similar paths, or are there distinct approaches here too?
The cohort displays a range of sophisticated capital allocation strategies. Each reflects their unique business models and strategic priorities. Some are what we might call dividend champions.
Dividend champions.
Yeah. RLI Corp, for example, has an astonishing track record. They've increased their regular dividend for 50 consecutive years. 50. Yeah. That demonstrates not just consistent profitability, but also incredibly conservative and disciplined management that prioritizes predictable shareholder returns. Chubb boasts a similar impressive track record, approved its 32nd consecutive annual dividend increase in 2025. For these firms, the consistent growing dividend is a core part of their value proposition. It signals predictable capital generation, attracts a stable, income-oriented investor base. This policy implies a high degree of management confidence in their long-term earnings power. And it creates a powerful incentive to maintain underwriting discipline to support that growing payout.
So consistency and reliability are key for these dividend champions. Signals a steady hand at the tiller. But what about a more flexible approach, maybe more opportunistic capital return?
Others employ a more flexible total return approach, often heavily featuring share repurchases alongside dividends. Primerica, for instance, returned a significant $163 million to shareholders in Q2 2025. But a substantial $129 million, that's 79% of it, was allocated to buybacks, with the remaining $34 million going to dividends.
So mostly buybacks there. Why?
It indicates a management belief that reinvesting in the company's own shares at current prices is a highly accretive use of capital, particularly if they believe the stock is undervalued. W.R. Berkley also utilizes a dynamic approach, frequently supplementing its regular dividend with special dividends and opportunistic share repurchases. In Q2 2025, they returned $224 million to shareholders, and $190 million of that was a special dividend.
The special dividend.
This opportunistic strategy offers more flexibility than a rigid dividend policy. It allows management to adjust capital returns based on prevailing market conditions, internal investment opportunities, and their ongoing assessment of the stock's intrinsic value. It just means management has more levers to pull to optimize shareholder returns.
It sounds like management has more options to deploy capital based on what they think is best at any given moment, rather than being strictly bound to a fixed dividend growth policy.
Exactly. It's about optimizing shareholder returns given the prevailing market and internal conditions. Provides management with greater agility.
Okay. Next, let's look at financial leverage and creditworthiness. How do external bodies, like the rating agencies, assess these companies' financial strength? What does that tell us about their risk profile?
The financial strength of an insurer is critically important, and it's externally validated by leading credit rating agencies like AM Best, S&P, Moody's. They assess a company's ability to meet its policyholder obligations. It provides this independent seal of financial strength that's crucial for policyholder confidence and, frankly, for competitive advantage.
And what do the ratings show?
There's a clear correlation between an insurer's sheer scale, diversification, and its credit rating. The global diversified leaders, Travelers and Chubb, hold the highest possible financial strength rating, or FSR, from AM Best. A++ superior.
A++ superior. Top marks.
Top marks. The rationale for Travelers explicitly cites its broad spread of risk and diversified portfolio across geographies and product lines as key strengths. It highlights that shock absorber effect that diversification provides against severe stress events. They also typically receive top-tier issuer credit ratings like AA from S&P and A or 2A3 from Moody's, reflecting their exceptional capacity to meet financial commitments.
So the bigger and more diversified you are, the more bulletproof the credit agencies perceive you to be. Even if the specialists are maybe financial high flyers in terms of profitability, it's about ultimate security.
That's a fair assessment of the rating agency's perspective. While the specialty carriers exhibit excellent financial performance, they generally hold ratings one notch below the absolute top tier, reflecting that slightly more concentrated business profile. W.R. Berkley, RLI, and Arch Capital all have strong A+ superior FSRs from AM Best. Kinsale holds an A excellent FSR. AM Best notes its strong operating performance, but explicitly states a neutral business profile, which is an acknowledgement of its concentration in the E&S market.
So still strong, but that concentration matters to the agencies.
It does. These ratings recognize the specialist's superior underwriting, but implicitly account for the higher theoretical risk associated with their more concentrated business models. Selective also holds an A+ superior rating, and Primerica's life insurance subsidiaries are rated A+ superior, reflecting their strong capitalization and consistent profitability. So while all these companies are rated very strongly, the sheer scale and diversification of the global leaders do give them an edge in the eyes of the rating agencies for ultimate financial resilience.
Our final point in this section is the litmus test of reserving. What exactly does that refer to in insurance? Why is it so crucial for understanding an insurer's financial health and maybe their underwriting discipline?
An insurer's reserving practices are an absolutely crucial indicator of its underwriting conservatism and the true quality of its earnings. Essentially, insurers have to set aside money, these are called reserves, to pay for future claims that have already occurred but haven't yet been fully settled. It's a complex actuarial estimate of future costs.
Right. Setting money aside for the future.
Exactly. Consistently releasing reserves from prior accident years, that's known as favorable development, suggests that the initial loss estimates were prudent, maybe even a bit conservative. They set aside enough or maybe even a bit more than what was ultimately needed to pay claims. This favorable development then adds to current earnings, providing a nice tailwind.
Okay, favorable is good. What's the opposite?
The opposite is needing to strengthen reserves for prior years. That's called adverse development. This can signal that past underwriting was inadequately priced or that claims from previous periods were underestimated. That then negatively impacts current earnings. It's basically a retrospective look at how good they were at predicting future losses, and it directly speaks to the integrity of their underwriting and pricing.
And we saw earlier that some companies face challenges here, particularly Selective. What was the root cause of that adverse development?
Yes, Selective Insurance Group has indeed faced recent and significant challenges in this area. In Q4 2024, it recorded $100 million of net unfavorable prior year casualty reserve development. That's a substantial amount, which added 8.8 points to its combined ratio, significantly reducing its profitability for that quarter. They took another $45 million charge in Q2 2025 for the same reason.
Why? What caused it?
Management attributes these actions directly to social inflation. That's an industry-wide trend of rising litigation costs, broader definitions of liability, and increasingly larger jury awards. It's particularly prevalent in general liability and commercial auto claims. This is an insidious trend because it causes past claims losses to develop beyond original expectations. It makes it a significant pressure point for carriers in those long-tail casualty lines, and it's a really difficult risk to quantify because it's driven by evolving social and legal trends, not just actuarial tables.
So they had to essentially admit they hadn't put enough aside for claims from previous years, directly hitting current earnings. In contrast, who excels at this litmus test of reserving?
Exactly. It's a clear signal that past pricing was insufficient for the losses that ultimately emerged. In contrast, firms like RLI and Travelers have consistently reported favorable prior year reserve development. That's provided a welcome tailwind to their underwriting results. In Q2 2025, Travelers reported $315 million in favorable development, while RLI reported a $24.4 million net increase to underwriting income from the same source.
That sounds like a hallmark of good management.
It is. This consistent favorable development is a hallmark of a disciplined and conservative underwriting culture. It demonstrates a deep understanding of future loss trends and a willingness to price for them from the outset rather than being surprised later on. It's a key indicator of strong management and robust actuarial practices.
Okay. Now that we've looked at their strategic foundations, operational models, financial performance, let's explore how the market actually perceives these companies, translating all those factors into valuation, and then turn our attention to the distinct challenges they face moving forward.
Sounds good. This is where it all comes together in terms of market perception and future outlook.
After all this analysis, how does the market actually value these companies? Your sources provide a relative valuation framework showing how investors perceive their growth, profitability, risk, and then, yes, we'll turn to the future. Look at the unique risks, the strategic pathways each archetype is forging as they navigate this ever-changing world.
Right. The market's valuation multiples, things like PE, PB ratios, they're essentially a collective statement about investor confidence. It's where all these strategic and financial differences get distilled down into a price. And it reveals a clear segmentation in how different types of insurers are perceived. Investors are making a bet not just on current performance, but on the future sustainability of those business models and management's ability to execute against evolving challenges.
Let's break down this relative valuation framework then, using those common metrics, price to earnings, PE, and price to book value, PB. Who commands a premium in the eyes of investors and why?
Okay. The market clearly assigns a distinct premium to the high-growth, high-ROE specialty insurers. Kinsale, for example, commands a significantly higher price-to-book multiple of 6.1 and a price-to-earnings ratio of 23.6.
Much higher than the others.
Much higher. This premium is justified by its consistent 30% plus return on equity and that 30% plus revenue growth we talked about. Investors are clearly paying a premium for its technology-driven underwriting advantage and its long growth runway in the E&S market. They view it as a best-in-class operator that can grow rapidly while maintaining exceptional discipline.
And Progressive.
Progressive also commands a premium, PB of 5.7, PE of 14.5. That's relative to most traditional P&C carriers. This is due to its consistent above-average growth, powerful brand, and that perceived durable competitive advantage in data and analytics, which promises continued market share gains. RLI 2 shows a premium PE of 24.2, PB of 3.6, reflecting its consistent underwriting profitability and long track record of disciplined performance.
So consistently high growth and high sustainable profitability equals premium valuations. It's fascinating how the market dissects these companies, isn't it? It's not just about profit, but how you make it and your future potential. What about the larger, more mature players? Or those facing more headwinds?
Indeed. The valuation spectrum within this cohort really encapsulates a fundamental trade-off for investors: growth at a premium price versus value and stability. In contrast, the large, mature global leaders like Travelers and Chubb, along with regional players like Selective and even Arch Capital, they tend to trade at more modest, value-oriented multiples.
Give you some numbers there.
Sure. Travelers has a PE of 12.1, PB of 2.2, Chubb is at PE 12.9, PB 1.7, Selective at PE 12.8, PB 1.5, and Arch Capital at PE 11.2, PB 1.5. For these companies, the investment thesis is less about hypergrowth, more about stability, diversification, and the consistent generation of excess capital that's reliably returned to shareholders through growing dividends and strategic share buybacks. Their valuation reflects their status as reliable, blue-chip compounders rather than high-growth disruptors, offering steady returns.
And what about Primerica? Seems like a unique case here. Very high ROE, but a more modest PE.
Primerica presents a fascinating situation in this. That's a crucial point. And the risk profiles are as distinct as their business models. An investment in the insurance sector isn't a monolithic bet. It's really a specific wager on a company's ability to manage a particular set of challenges.
Okay, what are the big ones?
First, there's catastrophe risk, cat risk. This is perhaps the most visible and volatile for insurers with substantial property exposure. We're talking about companies like Travelers, Chubb, and Selective. Their financial results are heavily influenced by the frequency and severity of natural disasters, hurricanes, wildfires, severe storms, winter weather.
You see that in the headlines.
Absolutely. For example, Travelers' Q1 2025 results were materially impacted by $2.27 billion in pre-tax cat losses, mostly from California wildfires. That added a substantial 21.2 points to its combined ratio for the quarter. The ongoing challenge for these firms is to use incredibly sophisticated modeling, disciplined underwriting, and robust reinsurance programs to manage and adequately price this exposure over the long term, especially amidst a backdrop of increasing climate volatility.
So even with all their diversification, Mother Nature can still hit them hard, cause significant earnings volatility.
Absolutely. Then we have social inflation and reserve risk. This is most acute for carriers with significant exposure to those long-tail casualty lines, general liability, commercial auto.
Remind us about social inflation again.
It refers to that trend of rising litigation costs, expanding definitions of liability, and increasingly larger jury awards. It causes losses for claims from prior years to develop far beyond original estimates. Selective's recent adverse development charges, that $100 million in Q4 2024, another $45 million in Q2 2025, were directly linked to this. It significantly impacted their earnings. W.R. Berkley has also highlighted social inflation as a key concern. It injects this additional layer of complexity into predicting future losses.
That's a really difficult risk to quantify because it's driven by social and legal trends, not just historical actuarial data. Makes it quite unpredictable.
Precisely. Next is competitive and cyclical risk. The entire P&C industry is inherently cyclical. You have soft markets, intense price competition, declining rates often followed by hard markets, where prices rise and underwriting gets stricter.
And how does that affect these groups?
The E&S specialists Kinsale, RLI, WRB, ACGL, they've been major beneficiaries of the recent hard market conditions. That fueled their explosive growth. However, they face the inherent risk that an influx of new capital into the E&S market could lead to a market softening. That would inevitably pressure their growth rates and those high underwriting margins.
And Progressive.
Progressive faces a different but equally intense form of competitive risk, a perpetual battle for market share in that highly transparent, price-sensitive U.S. personal auto market. Massive advertising budgets, sophisticated pricing algorithms, a constant fight for customer attention that's just the cost of entry for them.
It's a constant high-stakes fight for market share in that personal line space. And finally, the unique distribution model risk for Primerica. This feels very specific to their structure.
It absolutely is. Primerica's unique business model carries a unique and significant risk. Its growth's fundamentally contingent on its ability to effectively recruit, train, and motivate its massive independent sales force. With over 152,000 representatives, a significant decline in recruitment, a rise in agent turnover, or a decrease in individual representative productivity could directly impede its ability to sell new policies and gather assets. It presents a major headwind to future growth if that network falters.
Because their human capital network is their primary growth engine.
Exactly. The health and vitality of that network are paramount to their success.
Okay. So every company has a plan for what's next, right?
Yeah.
A strategic thesis for how they'll navigate these risks, capitalize on opportunities. Your report outlines distinct strategic questions for each archetype, defining their forward-looking strategy. It's really about how they plan to leverage their strengths and address their unique challenges in the years to come.
Right. There's no single best strategy for the future, but rather a set of distinct strategic questions that define the forward-looking thesis for each archetype. This is where management's ability to execute truly comes into play as they navigate their unique challenges and opportunities in this dynamic environment.
Let's walk through them. What's the thesis for the global diversified leaders?
For the global diversified leaders like Travelers and Chubb, their core thesis is that their immense scale, broad diversification, and deep data advantages will allow them to generate stable, through-the-cycle returns and consistently produce capital in excess of their growth needs. Their path forward involves continually leveraging advanced analytics to refine underwriting and pricing, enhancing digital tools for both agents and customers to improve efficiency and experience, and maintaining their disciplined approach to capital returns, growing dividends, strategic share repurchases.
And the key question for them.
The key question is, can they effectively deploy their formidable advantages to achieve their target mid-teens ROEs consistently, even in the face of significant and potentially increasing catastrophe volatility and global economic shifts?
So it's about continually reinforcing their existing strengths while managing those big, unpredictable global risks that come in their scale.
Precisely. It's a strategy of compounding consistent returns from a position of strength and resilience.
What about the specialty underwriting champions?
For the specialty underwriting champions, WRB, RLI, ACGL, KNSL, the thesis is that their deep expertise in niche markets will continue to generate superior underwriting margins, even as the market evolves. Their strategy is to remain incredibly disciplined, demonstrating a willingness to walk away from underpriced business during soft markets and aggressively capitalizing on opportunities during hard markets when their pricing power is strongest. Kinsale, specifically, further leverages its proprietary technology platform to maintain its industry-leading expense advantage and drive efficiency.
And their key question.
The central question for this group is whether they can successfully defend their consistently high margins and returns as the E&S market cycle inevitably turns, and as competition intensifies, both from new entrants and existing players looking for higher margin business.
It's a delicate balance for them between exploiting opportunities when they arise and maintaining strict underwriting discipline when conditions become less favorable.
Absolutely. Their continued success hinges on that astute judgment and unwavering discipline.
And Progressive, the personal lines innovator.
For Progressive, their forward-looking thesis is really encapsulated in their destination-era strategy. This aims to leverage its dominant position in personal auto insurance to become a broader provider of other products, most notably homeowners insurance.
Moving beyond auto.
Exactly. By skillfully bundling policies, deepening customer relationships beyond just auto, the company seeks to increase customer lifetime value and build an even stickier, more comprehensive insurance franchise. The key question is whether Progressive can successfully translate its powerful brand, data advantages, and direct distribution model from the auto market into the structurally different and highly cat-exposed homeowners market, where the dynamics of risk and customer expectations can be quite distinct.
That's a huge undertaking, expanding into an entirely new, very different, and highly competitive line of business. The success of their destination era really hinges on that pivotal move.
It truly does. It's a big bet.
What about the super regional, Selective?
For Selective, the super regional Main Street player, their path forward is focused on achieving target profitability by carefully balancing disciplined growth with their relationship-based agency model. Their strategy involved continued, selective geographic expansion into new states, investing in technology to enhance the agent and customer experience, and taking decisive underwriting and pricing actions to address those persistent challenges of social inflation in its casualty lines.
And their key question.
The critical question for Selective is whether these actions, combined with their high-touch model, will be sufficient to consistently bring its combined ratio back to its long-term target and generate stable double-digit operating ROEs, overcoming the recent headwinds they face.
They clearly need to demonstrate they can overcome those recent reserve development challenges we discussed earlier.
Precisely. That's a key focus for them and for investors watching them.
And finally, Primerica, the middle market disruptor.
For Primerica, their strategic thesis is centered on the continued growth and productivity of its vast sales force to further penetrate that enormous and often underserved middle-income market in North America. The company aims to leverage its distribution scale to grow its high-margin term life business and significantly increase sales of its investment and savings products, thereby expanding its share of the client's wallet.
And the big question for them.
The key question here is whether its unique face-to-face distribution model, which relies so heavily on human connection and trust, can continue to thrive and attract new representatives in an increasingly digital world where consumer behaviors are constantly evolving and digital channels are becoming ever more prevalent. Can that human network model endure and grow?
What an incredible deep dive into the world of insurance. We've seen that insurance is far, far from a monolithic, dull industry. Instead, it's this vibrant, dynamic ecosystem of distinct business models, each with its own advantages, inherent challenges, and specific strategic bets on the future.
Yeah, from global giants managing vast, diversified portfolios to agile specialists carving out incredibly profitable niches.
And from tech-driven direct sellers to human-powered network builders. The diversity in how these companies approach risk and value creation is truly striking.
It's clear that while the underlying purpose of insurance remains constant, effectively managing and mitigating risk, the methods and strategic pathways to achieve that purpose are incredibly varied and innovative. Each archetype represents a fundamentally different philosophy on how to generate sustainable value and maintain a competitive advantage in this essential sector of the economy.
Understanding these 5 archetypes and their individual strategies gives you, our listener, a powerful framework. A way to analyze not just these specific companies, but the broader financial landscape as a whole. You can now see why a seemingly boring industry is actually a masterclass in strategic choice, disciplined risk management, and the constant evolution of how value is created and delivered. It really changes your perspective on what insurance companies actually do.
Yeah, you're no longer just looking at a balance sheet or a quarterly earnings report in isolation. You're seeing the intricate strategic decisions, the competitive positioning, the operational nuances that underpin those numbers. You can now discern why different companies perform so differently, what unique challenges and opportunities lie ahead for each, and how they navigate an incredibly complex global environment.
So, as you consider these varied and often contrasting approaches, which of these fundamental strategies, be it broad diversification, deep specialization, direct digital engagement, that relationship-intensive regional focus, or the human network expansion, which do you think will ultimately prove most resilient and adaptable, especially in the face of future uncertainties, things like accelerating climate change, the pervasive impact of AI, shifting consumer behaviors, evolving regulations, and why? That's definitely something to mull over.
A truly challenging question, as each strategy has its inherent strengths and its unique vulnerabilities to these profound shifts. The future will certainly test them all in different ways, highlighting the importance of adaptability and foresight more than ever.
Thanks for diving deep with us today. We hope you feel more than just informed. We hope you feel inspired to keep exploring the hidden dynamics of the world around us.